Warren Buffett. The name alone just screams investing success, right? But how did he actually do it? It's so tempting to think there's some kind of complex secret formula locked away in a vault in Omaha. But the reality? Well, the reality is a set of incredibly powerful and surprisingly simple principles that honestly anyone can get their head around. So let's dive right in and open up this playbook. And we're going to start with the absolute core of his philosophy. Now, this isn't just some clever line for a coffee mug. This is a direct challenge to our most basic human instincts. It's all about emotional discipline. And trust me, it is the key that unlocks everything else we're about to cover. To really get Buffett's genius, we first have to understand the ideas he was pushing back against. So let's take a look at the conventional wisdom that he so brilliantly rejected. Okay, so back in the day, especially in the 70s, this thing called modern finance theory was basically holy scripture in business schools. This efficient market theory, as it was known, essentially told a whole generation of investors, hey, don't even bother trying to find undervalued stocks. It's pointless. The market, they said, already knows everything. Now, here's where it gets really interesting. Buffett finds his entire edge in the nuance of a single word. See, he actually agrees the market is frequently efficient. But, as he says, the difference between frequently and always is literally night and day. And that gap, that's where human emotions like fear and greed come roaring in, creating massive opportunities for anyone who can keep a level head. And this quote just brilliantly sums it all up. See, Buffett didn't see this academic theory as some law of nature. Oh no, he saw it as a massive competitive advantage. While basically everyone else was being taught not to think, he was busy thinking, he was analyzing, and he was finding incredible bargains. So if following the crowd is out, what's the alternative? Well, that brings us right to Buffett's first and maybe most important principle. And it requires a complete shift in how you see things. This right here, this is the foundation of everything. A stock isn't just a blip on a screen that you hope goes up. It is a fractional ownership of a real company with real employees, real products, and real profits. Your goal is simple. Buy a piece of a business you can actually understand. A business whose earnings you're pretty darn confident will be higher in 5, 10, or hey, even 20 years from now. And believe me, Buffett absolutely practices what he preaches. These principles are pulled straight from Berkshire Hathaway's own playbook. They communicate honestly, they treat their own stock as something precious, not just confetti, and they don't get caught up in frantically trading their businesses. Why? Because they act like long-term owners, not short-term speculators. Thinking like an owner also means something else. It means trusting great managers to run the businesses you own. Buffett has zero interest in running the day-to-day show at Coca-Cola or American Express. He wants to partner up with excellent management and then just let them do what they do best. Okay, so let's say you've done it. You've bought a piece of a great business. But now what? What do you do when the stock market starts going completely nuts, with prices swinging wildly day after day? Well, this brings us to principle 2 and one of the best stories in all of finance. So this character, who was actually dreamed up by Buffett's mentor, Ben Graham, is your partner in a private business. And every single day, without fail, he shows up at your door, and he names a price at which he'll either buy your half of the business or sell you his. On his good days, Mr. Market is just on top of the world. He is completely caught up in wild optimism, and he'll offer you a ridiculously high price for your shares. Now, as a smart business owner who knows what the company's really worth, you're free to sell to him, or you can just ignore him and go on with your day. But then there are the bad days. On those days, he's paralyzed by fear and pessimism. He's absolutely convinced the business is doomed, and he offers to sell you his stake for a tiny fraction of its true value. And here's the crucial point. His wild mood swings create your opportunity. You can take advantage of his despair and buy him out on the cheap. And this is the punchline to the whole story. In the short run, Mr. Market is just a voting machine, totally driven by popularity and emotion. But eventually, the market becomes a weighing machine, recognizing the true underlying value, the actual weight of the business. The intelligent investor just uses that silly voting machine to their advantage, knowing that the weighing machine will eventually prove them right. All right, so we know we need to think like an owner, and we know we need to ignore Mr. Market's crazy mood swings. But what kind of business should we actually be looking to own? Well, that brings us right to principle number 3, focusing on truly wonderful businesses. Now, Buffett learned this lesson the hard way. It is so much better to pay a fair price for a wonderful company than it is to pay a wonderful price for a fair company. A wonderful business has what he calls a moat, some kind of durable competitive advantage. For that business, time is its best friend. For a mediocre business, time is the enemy. As Buffett famously says about struggling companies, never is there just one cockroach in the kitchen. This quote just captures the idea perfectly, doesn't it? Don't let yourself get seduced by a cheap price tag. Focus on quality. A piece of an extraordinary business is infinitely better than owning 100% of a struggling one. So what is it that creates this amazing quality? Well, it's often something Buffett calls economic goodwill. Now, that's just a fancy term for the powerful intangible assets a company has. Think about the brand name of Coca-Cola or the patents for a blockbuster drug. These assets, they allow a company to earn huge profits without having to constantly invest in more factories or more equipment. And as Buffett notes, during times of inflation, this is the gift that just keeps on giving, because the value of that brand can grow without needing tons of new cash. So when you put all of these principles together, thinking like an owner, ignoring the market's madness, and focusing on wonderful businesses, you arrive at the ultimate competitive advantage in investing. And this is the bottom line. This is the end result of applying the playbook. All the market's frantic activity, the constant trading, the obsession with what's happening this quarter, all it really does is transfer wealth from those who are impatient to those who are willing to just wait. See, it all comes back to emotion. These two forces, fear and greed, they're what drive Mr. Market's moods. They cause people to buy high when they're euphoric and sell low when they're in a panic. They are the sworn enemies of rational, long-term business ownership. And here we are, right back where we started, full circle. You do not need a crystal ball. You don't need to predict recessions or bull markets. The entire strategy, the whole thing, boils down to having the discipline to act like a rational business owner, especially when everyone else is losing their minds. Ultimately, the Buffett playbook is less about finance and a lot more about temperament. It's about choosing which game you actually want to play. One is this frantic, expensive game of musical chairs. The other is the patient, steady compounding of wealth by owning pieces of great businesses. The choice is yours.